People Not Titles podcast, October 28th, and Matt, day 28 of the government shutdown. It is finally seeping in to the real estate industry. We'll tell you how. Plus, the NAR working group, which comprised of 15 of the top CEOs and brokerages across the country, and the latest market stats coming at you right now. Well, hello, this is Steve Kaempf with the People Not Titles podcast. I'm here with my partner, Matt Lombardi. Matt, glad to have you here.
Good morning.
Awesome. We're excited. Coming off a big weekend, Matt. We'll talk about that, but it's October 28th and day 28. So if you wonder, how long has the shutdown been, Matt? All I have to do is just look at the calendar.
Makes it easy.
Makes it easy.
Makes it easy.
Matt, the federal government has entered its fourth week, and it is starting to impact 18% of the U.S. market, economic market, the real estate industry. Let's talk about what's happening there, Matt.
So it's unfortunate that our elected officials still cannot get on the same page. We won't get into talking about the issues.
Yeah.
But as with anything, the longer things languish and go unsettled, some issues are going to come up. So with the general population, we're going to talk about some of these things with day 28 of the government shutdowns. So number one, pending home sales have slipped below last year's levels, and that's the first time in many months, suggesting that buyers may be hesitant because there's too many unknowns.
Yep.
You know, people want security. Right?
They want normalcy.
Right, normalcy.
And maybe we'll accept no government as the new normal, Matt, but I don't think we're ready for it right now.
Yep. So number two, economists are saying there's broader economic jitters, not just related to the shutdown, that's keeping housing demand weak, such as consumers are cautious about their jobs and finances. Of course.
Yep.
Inflation has grown a little bit, many unknowns. So people want, once again, stability. Number three, over 1 million federal employees are either furloughed or working without pay. And as the shutdown continues, that may impact mortgage payment, real estate tax payments, other outstanding, rents, credit card debt. You put it out there, you don't have a paycheck, you can't pay.
Yes.
So the longer this goes on, and that's going to impact not just the housing market, but everybody else's.
Yeah, and Matt, we talked about mom and pop investors. And so if you're an investor and you're not, let's say, well capitalized like BlackRock or whoever it is, and you're trying to just keep the properties updated, build your investment portfolio, all of a sudden, there's a certain percentage of people that are not able to pay rent. That's going to impact you and start to create a story there.
Yep.
Also, Matt, we talked about last week the absence of federal economic data. So now, is the Fed flying blind in some regards?
Right, and I'm going to give a little shout out to you because last week you said maybe the private data could be more credible than
Matt,
what the Bureau of Labor and Statistics may be pumping out. But yeah, so the Fed needs data points, and if the government can't provide those data points, they need to find them somewhere else. So these private sources will be providing that. And then the last, I think, point that we'll make is that NAR and the Mortgage Bankers Association report that there's a growing ripple effect, including loan processing delays, and estimates upwards of 2,500 delayed originations per day. So that's going to impact the market as we know it, which needs fluidity, regularity, and consistency.
Matt, a silver lining here is that, as this impact widens now into the housing market, which is 1/5 of the U.S. economy, it's going to put more pressure for the government to reopen. And so this is all pressure to get it open, and I hope that we're able to come to a resolution on this soon.
Right, 28 days, not good, and I see no hope.
Right.
In the next couple of
Matt,
days.
there's always hope, and we are here to bring it. Matt, pro-agent restore trust in NAR working group. This is interesting. Matt, we've talked about it since the very beginning of the shenanigans with that NAR, which happened long before the settlement. As you know, you were inside the belly of the beast. Now, the NAR, in an attempt to restore trust and maybe save their butts, has put together a group of top brokerages for a secret squirrel convention. Let's talk about it.
Yes, so the name could probably be better. So what they're calling this, as Steve just said, is the Pro Agent Restore Trust in NAR Working Group. That's a lot of words to say that it's a core group of CEOs of major real estate brokerages. They're saying about 15. And as you said, this is secret.
Yes.
Nobody knows who these 15 are. There is one individual.
One person has been vocal.
So this gentleman's name is Dan Duffy, who's the CEO of United Real Estate Holdings. I think they're out of Dallas or at least somewhere in Texas. Here's a fun fact of Mr. Duffy. He was actually part of season 3 of Undercover Boss.
Wow.
So if you want to see
check that out.
So if you want to see who Dan Duffy is, season 3 Undercover Boss. I forget what year that would be.
Okay.
But that's a little side note.
Was he ever on Dancing with the Stars? That's what we all want to know.
Probably
Matt.
not.
No.
I hear it's very popular.
Yeah.
But
okay.
so this secret, as you said, secret squirrel group includes 15 CEOs from some of the largest brokerages, and they're representing around 100,000 agents collectively from their brokerage ranks. The group formed April of this year, and this follows the beginning of the settlement payments from NAR. And what happened, as we've talked about, and as you loyal viewers and listeners know, the large brokerages were left high and dry as part of the settlement, which created lots of pain and bad blood between these larger brokerages that had to fend for themselves and literally cut checks for millions of dollars because they felt their association, NAR, let them hang out there in the wind and you're on your own. So that, I believe, is the catalyst for everything.
Yes.
I think if these large brokerages were included in the primary settlement, half of these things would have not bubbled to the surface, but here we are.
Matt,
Yes.
And my thought on this is two things. Number one, this isn't just about the NAR settlement, although this is the catalyst for it, because many of these brokerages, whom we know, we interact with all the time, these big brokers saw the warning signs of buyer agency and all these different things that eventually came home to roost. They wanted these changes to be made, and NAR was just kind of business as usual. And it seems like their voice was not heard. And now there's a real threat to the business model of NAR. On the flip side of this, I say it's a great sign. I believe that they're going to get real feedback and real intel. And I give NAR an A+ for at least trying to bring this group in, because you're meeting with people that are really angry with you. And Nikea Wright is kind of outsider, so I think that positions her well in being able to distill this information to get a go-forward plan for NAR. So now you have, Matt, some bullet points on the recommendations from the group. Let's go through
So
that.
these just came publicly today.
Hot off the wire,
Hot
Matt.
off the press, breaking news. So as we're saying, this initial meeting took place in April of this year, and then this group of 15 met this month.
Yes.
Where now you have, here's the next step. So I think there's 6 points here. And as you said, we have some inroads with some large local brokerages here, and I think this echoes a lot of what we already know. So for you guys out there, number 1 recommendation is on the clear cooperation policy, and the group warned that the CCP could expose NAR brokerages and agents to future litigation. 100% correct. This group said that multiple listing options for sellers policy does not fix the legal risk that's out there right now. And they're asking NAR to host a working session with legal experts, brokers, agents, and industry leaders to find a better solution. They also criticized the lack of inclusion in policymaking, saying it adds to the trust gap between NAR and its members. So clear cooperation policy remains this big topic, not just for what Kaempf is continually talking about with the private listing networks, but with these other large brokerages. And we've talked about Howard Hanna Real Estate Group saying, hey man, we may pull out of the MLS. We got enough business, we don't need you. And so there's going to be threats from brokerages to fix this clear cooperation policy. And it's trying to be a one-size-fits-all for the U.S. real estate market. And what we see is that's not going to work.
Yeah, Matt, and I think too, this points to the fact that I think viewing NAR as the most powerful real lobby in the country, not just a real estate lobby, but a powerful real estate lobby, the largest in the country. I think most brokerages kind of sat back and said, they're going to have our backs. These people are so big they can't lose. And when they lost to the DOJ, they started to say, we are not going to trust the NAR as a representative with us in these legal matters that wind up costing us millions of dollars unless we have a voice, unless we get ahead of it. So in this case, you have savvy business owners that are looking to protect their interests, that are partnering with the NAR to create a legal strategy so they're protected from the boogeymen, which are in the bushes already, coming out at inopportune time. So let's talk about the three-way agreement that the NAR has.
So recommendation number 2, as Steve just said, is the NAR three-way agreement, which is mandatory membership for people in the real estate industry, in the realtor organization. You need to join your local, state, and the National Association of Realtors. And they're saying that mandatory membership three-way agreement could violate antitrust laws. And we've already seen that, where several brokers
People are
and
challenging
agents have already challenged the three-way agreement, and they are moving through the courts as we speak. Group is urging NAR to review or restructure this membership three-way agreement through a transparent process. So the three-way agreement has always been in place, and now it's, I think, at its weakest point more than ever. You know, I think you said a great point just a moment ago, Steve, that for years, NAR protected the brokerages and their members, shielded them from continued lawsuits. They were always winning. And then they weren't winning, and now they're at they've created this vulnerable situation in the industry where, like you said, the wolves are out there. They're looking for cracks in the armor to say, we're going to find a way in to get things changed and or some of your money.
Yeah, Matt, and I think this three-way agreement was the grip on the industry, and now we're seeing that grip loosening by lawsuit, by recommendations from top brokerages that they need their sponsorship and endorsement of to get all these agents to play ball. Okay, Matt, restructuring and transparency.
Yeah, so point number 3 from this work group is mostly financial transparency. And so they're demanding clear financial transparency and a public restructuring plan. NAR's finances, because they are quote unquote a not-for-profit, you don't see most of the stuff that's in there. They publicly have to file their tax returns by a certain date, but it's not always timely. You know, part of this restructuring and transparency is, I think it was about a year ago, NAR pulled from their website, which has been there for years and years, the membership data. You know, how many realtors are there by state and nationwide?
Yes.
That's gone.
Yeah, so you can't do the math anymore.
You know, so that part of this work group is saying, which I agree, put everything out there in the open. I mean, what are you trying to hide with your financial things? So they've requested access to financial data, membership numbers, and NAR's 990 tax filings. They said NAR's communication so far amounts to lip service and called for specific written plans and targets to restore that trust. 100% correct. I would agree with that statement.
Yes.
Nobody knows. If you're a realtor out there, I guarantee you have no idea what the financial situation of NAR is.
And their financial power comes from all the agents and the brokerages, Matt. So they want to know, where's our money going? And they want to go from propaganda and BS to real, authentic partnership. And this is what that looks like. Matt, number 4, the Declaration of Independence.
Independent governance.
Yes.
So for you, those of you out there, NAR is a very top-heavy organization in terms of their leadership and management. So first and foremost, there's no independent board members. Everybody's on the inside. They're realtors. Maybe there should be outside people in the industry looking at this, and so that's one of the recommendations.
And they technically get to hand pick them all the time, right, Matt?
It's a long process, and yes, these people have been in the
They've been
ecosystem.
vetted, they've been sifted, they've been around the tables. Okay.
So currently there's 8 paid executives. So the volunteer leaders, once you reach that highest level, you're getting paid. You're giving up your day-to-day operations as an agent or brokerage, and you become a full-time staff person.
Right, you become
leading
one of them.
NAR. There's also about 1,000-member board of directors that meets theoretically twice a year. I'm sure they could meet more than that than necessary. But 1,000 people trying to direct the business of the NAR. And there's about 95 committees that feed into the board of directors. Big organization, a lot of moving parts. This group says that independent oversight is essential for the fiduciary alignment and long-term credibility of NAR, and they're asking for structural reform to include independent governance in NAR's leadership model.
Yeah, Matt.
Steve, what are your thoughts?
Matt, and the question I have in my mind is, was the DOJ the arm of the government that decided the NAR is too strong, too powerful, we need to give them a loss, we need to start fracturing up the power of their group, because most of the time the entire industry walked lockstep behind the NAR, and so now we're starting to see their power. I'm not talking conspiracy theory here. I'm just saying this looks like it's weakening the most powerful lobby in the country. Matt, let's get on to the balance sheet.
So apparently NAR's net assets fell from $747 million in 2022 to $363 million in 2023 after all these legal losses. But this working group still says that is still an excessive amount of money. And I would say that $363 million is an excessive amount of money.
Yeah, that's kind of a nice little emergency fund.
And this group argues, and I agree with this statement, that these large reserves make NAR a continued target for future class action lawsuits. As we've said with the Sitzer-Burnett case, you affected parties out there, if you apply for your money, you might get a check for $200, and the biggest winners were the plaintiff's attorneys.
Matt, and when I look at this, I think one of the big surprises for everyone is that the $747 million in their coffers to begin with, because they're thinking to themselves, listen, what does the NAR do, and how did they amass so much wealth? And we know the answers to these questions. So they're looking at, this is our money. We are the businesses that are taking all the risk, and the NAR is just scooping in the money. And so that might be the view of some brokerages. So what are some of the remedies suggested here, Matt?
So this group suggests a few possible uses of this extra money, one being lowering member dues, at least for a short time period, maybe a year or two. Reimbursement for legal costs for the brokerages affected by the lawsuits.
Yes.
So, of course, the large brokerages who had to shell out millions of dollars, they'd love for NAR to reimburse them.
Yes.
And I'm sure they would be happy even with 50% reimbursement. And then the third suggested remedy includes potentially paying dividends to agents. I don't know if any of these things would move forward, but they're interesting takes.
Yeah, Matt, and the real question I have is, who owns the NAR, and where's this money going to go, and for the good of who? So those are questions.
So you had said, where is this money coming from? So we went over this at some point late last year or early this year. When you multiply $155 times $1.5 million, that's where you're getting a large part of it.
Matt.
But they have 2 fully paid off buildings, one on Michigan Avenue in Chicago, one on New Jersey Avenue, right 2 blocks away from the Capitol. Beautiful building. Those are major assets. They have reserve funds as part of their budget that include there. And then the third component, which I think is the grayish area, is Second Century Ventures, which is a for-profit investment arm under NAR.
Under the umbrella.
So Second Century Ventures is a for-profit venture capital arm of NAR. And I was there when this was birthed, and it's a great idea. There's a lot of small companies out there that are doing great things in the real estate industry. Hey, why don't we, NAR, invest in some of those companies so when and if they take off, we have a piece of it, our members could reap the benefits of this. The company that most of you will know that NAR invested in and still has a large stakehold with stock is DocuSign. That is probably their shining example of a winner under Second Century Ventures. I know they probably have 100 plus other companies that they have investments in. I know there is a website. I don't know what publicly is on there other than who the companies are that have been invested in by Second Century Ventures. And I think this is a pain point for this broker work group is how much money is actually sitting here.
Yes.
And I guarantee it's a lot.
Matt, and you said the words, I forget what the first thing you said, because you said it only 3 minutes ago, but the last thing you said is, and the members reap the benefits of creating this, that we create this private fund, we invest in small companies, and I think the question is going to be brought to bear, did this members reap the benefits aspect ever come to fruition? If it didn't,
right,
people are gonna look at this and go, what is going on with my money?
Right. So from a financial standpoint, I would say no. The members are not reaping or getting any benefit from this. From an industry company perspective of making your lives easier, or perhaps the lives of home buyers and sellers easier from these companies coming into play, yes. But yes, the financial side of it, that is the gray area that I think people want to get to the bottom to. And so I'm not surprised this work group is asking, for, disclosing all financial information, what members actually get from these partnerships and arrangements. And they're also suggesting formalizing a relationship to ensure that the value of these investments flow back to realtors.
Yeah, and Matt, you look at the 363 million is left. Is that part of this SCV or not?
Right.
So there seems to be a little bit akin to Doge needing to come in to the NAR. Matt, what's the conclusion here? Let's button this up.
So NAR acknowledges the group's outreach, calling discussions productive and part of their feedback mission to restore trust. And IKEA Wright has been on a trust building tour, hiring senior executives and or consultants to make inroads in the brokerage community, MLS community, et cetera. So we've complimented her and NAR for what they're trying to do.
Absolutely.
NAR it pointed out that its upcoming 2026 to 2028 strategic plan is going to come out, where it's going to address a lot of these things. And the 2025 annual report will show that they are modernizing operations, improving transparency, and strengthening their consumer marketing play. Big brokers, keep it up.
Yeah.
Because you are the lifeblood. They are the business people running the industry.
Yes.
And no offense, NAR, I was one of you.
Yes.
On the inside.
Yes.
We were not business people. Now, some of us operated like businesses, but a trade association and managing that is different than managing the day-to-day operations of a business. So this broker group is going to look at things from a business perspective as opposed to just the member side of things.
Matt, and if all of this effort is just to put everyone back into their cages and to be quiet and, hey, let's get them back to where they were, then this is going to not work, in my view.
Agreed.
And what to me, what does not working look like? If these major brokerages, after sitting down, after having the talks, and after seeing results, do not actually see real authenticity with the partnership, you're going to start seeing them back out and pull away. And I think that'll be the canary in the coal mine for where NAR's future is going to be. So they need to be, this is a really important effort, and they need to work with authenticity on it. Matt, the Fed meets October 28th and 29th, which is today and tomorrow. What is likely to happen? They're flying blind. They don't have the economic data. Jerome Powell's really on the last leg of the marathon that he's been running.
He's a lame duck, chairman of the Fed.
Yeah.
So
Can there be a move that he makes that people go, he saved the day?
Well, I mean, he could cut rates by a full percentage point if he wants, and you'll get cheers and high fives across the board.
Right. From
President Trump will be high-fiving him as well.
And he'll still say he's too late. So I don't know that he could recover from that relationship. So that may not even be a thing that he wants to do.
So the bettors market, as well as most experts feel, there will be another rate cut, and it will be 0.25 basis points. I think it's sort of factored in already. If not, it's getting factored in because mortgage rates, we'll talk about that in a little bit, have steadily come down or at their lowest point in over 12 months. But yeah, so by 25 basis points, not 0.25 basis points. And the target range, once that is in effect, would be 3.75 to 4%. So mortgage rates typically ride about 2% more above that on average. So the announcement will happen, I believe, tomorrow.
Okay.
What transpires. So next week we'll talk about that.
We'll report on it. Matt, so young Americans investing in stocks rather than homes, record stock market versus unaffordable housing, several key data points here that show why they've pulled back, why this generation has rethinking home ownership. Let's talk about it.
We had an event last week where we did a presentation and
Your
talked about...
economic analysis, Matt, was much heralded.
Thank you.
You're an authority.
But the younger generation, Gen Z, which is the generation born around 1997 to 2012,
Yes.
are in their formative home buying years. This is the generation that's large, and we're hoping is going to buy lots of homes, and the exact opposite is happening. And there's a lot of factors involved with that, but a couple things that Steve and I are going to talk about right now is the success of the stock market and investments, and social media influencers out there who are telling the Gen Z generation, don't buy a house.
Right, a lot of podcasts
Don't invest in
out there.
property. You don't need to build wealth, or you're not going to build wealth through that. Instead, you rent your residence and invest the rest in the stock market because the stock market is where it's at.
The People Not Titles podcast is brought to you by Land Trust Title Services, your partners for results.
Where it's at. So this is a Wall Street Journal. Wall Street Journal reports that there's a growing connection between the record-setting stock market and the unaffordable housing market, and the way younger Americans view wealth building. So,
Matt, you talk about all the widening gap between renting and owning with higher insurance, property taxes, maintenance costs, right? Monthly mortgage payment on a $4,000 home now averages around $2,170 without even including those things, the taxes, insurance, and upkeep. Is that right? And so what does that mean? In contrast, renting a two-bedroom apartment can be $8,000 to $14,000 cheaper per year.
Right.
You take that money, rent, and invest the difference, it might be a better play.
right. So that's a great data point that I'm also going to talk about, which is the average monthly mortgage principal and interest payment on a $400,000 home averages about $2,200, we'll say. And that's roughly 30% of median after-tax income of individuals or families. And the total ownership cost can approach 50% when you add in, like you said, insurance, property taxes, maintenance, upkeep, et cetera. And that's a lot of money. And when you look at it, apples to apples, what is it going to cost me for the next 12 months to live in apartment A or buy a house? More kids, sorry, we're of a certain age where we could say that, are choosing to rent. And that's top of mind now. It's, not to put you on the spot, but you have 4 children.
Yes.
Any property owners?
We have one property owner.
So 25%,
Yeah.
and I have...
And have an
2
18-year-old.
Right. So I have a 24 and 22-year-old.
Yeah.
They are not property owners yet.
Yes.
Even though I asked them this question a week or two ago, and they said, yeah, absolutely, we're open to it. It's just we're not thinking about it because I'm not in that time frame.
Yes.
So younger generations are investing instead of buying. JP Morgan Chase study found that 37% of 25-year-olds had investment accounts in 2024, up from just 6% in 2015.
Yes.
So during the pandemic, a lot of kids who got some money from unemployment checks and or the government checks that were handed out, the Robinhood comes to mind, the Robinhood app.
Day
which
trading
was
at home.
just, hey, why don't you just trade some of that money away? And so many of the younger generation got on the Robinhood app and started trading, and that continues to today.
Matt,
for a fact.
We sat in a consortium of individuals. We had realtors, we had attorneys, we had other salespeople, entrepreneurs, business people, and they all had a different view on it. Some of them were, hey, kids these days are thinking, I want to travel. I don't, I've just, I want to live a little bit. I see these people jumping into the grind, nose to the grindstone. I don't want to be that person. I want to think differently. They're starting businesses, which people are being able to do that online and such. So that's one aspect of it. The other aspect of it is that some of them want to buy, when they look at the home they can afford, they go, oh, actually, I'll wait to get the home I want as opposed to the home I can afford. And so they want to make that play. So there's a number of different things.
A lot to unpack here, and I think we could spend an entire
We can
episode
spend an
talking
episode
about
on it.
Gen Z and
Yes.
Gen Y who are, as they what their view of home ownership is. I think they value owning property, but like you said, there's so many factors that go into today's thought process of, do I want to do this?
Matt, I had a fascinating conversation with an estate planner. He was in his late 20s, maybe early 30s, and he said this: I've done estate plans for many millionaires. There is not one millionaire I can think of that did not own real estate.
Once again, you look at how the vast majority of millionaires and billionaires in this country and probably worldwide created their wealth. Primarily, it is going to be through real estate.
Matt, so
that is proven.
100%. So Matt, where's the opportunity here? The opportunity is in this, in my view. As a real estate agent, and at NAR, and the whole bunch, and me, the whole goal is to make the case for home ownership, to make the case for building wealth that way, to make the case for the other elements, that it's not just a return on your investment, the community life, the stability of raising a family. All these different things are linked to home ownership, and that there needs to be a renewed value proposition that goes beyond just dollars and cents or rate of return or whatever it is. That's one thing. The second thing is, I think real estate taxes, DeSantis started putting into the zeitgeist recently about why should people, when you buy something from Best Buy, he said you don't come home and still pay for it 3 years later. Same thing with real estate taxes. I believe there's going to be a move in that. And then property insurance, we talked about this a couple episodes ago, ridiculous fraud, rising prices, people who are living in safe communities having to foot the bill for those living, 3 feet from the ocean or whatever it is. Excuse me. I think those things are going to be addressed, and we will see a turnaround once people get their mind straight about real estate.
So, you younger generation that are watching or listening to this, keep your options open for property ownership.
Absolutely.
It's not a bad gig. As Steve said, there's so many other factors that go into it. So,
Matt, then we had a viewer that came with this insight, and I resonate with it. The real estate market is like a what, Matt?
it's like a coiled spring.
Coiled spring.
Ready to just to
Leap
spring.
out.
So, housing is one of the most critical markets in America, second to only food and necessity and total dollar value. President Trump recently blamed the home builders for sitting on millions of empty lots. Hey, home builders,
Start building.
start building.
Yep.
However, the issue is bigger than just building on lots. Regulations, labor shortages, and high financing costs create barriers for these home builders to, they're for-profit companies.
Absolutely.
They're going to build stuff if they're going to lose money, and I think 25% of their bottom line has been given big give-backs for financial incentives for people who are buying new homes.
To offload these homes, yes.
So yes, why builders? Builders aren't just holding back.
No, their job is to build. That's
Right.
what they want to do, Matt.
So nearly 25% of a new home's price comes from regulatory costs per the National Association of Home Builders. Goldman Sachs estimates that relaxing land use regulations could add 2.5 million homes over the next decade, solving about 2/3 of the shortage. And I put a little note here. President Trump and his administration, I hope, get involved with this.
Absolutely.
I was thinking back when he was, before trying to secure votes.
Right.
He said, here's what we're going to do. We're going to open up federal lands. We're going to cut regulations across the board. It has not happened yet. I don't care about the federal land side of it.
I agree with that.
It's the red tape that these home builders or individual builders have to face in these local communities.
Right, they get tired from fighting their own, their own government just to try to build a simple home. So some of these regulations make sense, but people just sit around in rooms and make all kinds of crazy laws, like we have the Northwest Ordinance, and we have whatever the other one, Jackson Park, and they just love to come up with stuff to make themselves a splash. And very rarely do these regulations benefit anyone, Matt, besides them.
Yeah, the regulations, don't get me started.
Don't get you started, Matt.
So
the Coiled-Spring
housing thesis. This is great. So housing demand is definitely pent up, just waiting for lower rates and reduced and lighter regulations. And even when a small rate drop happens, it unleashes people who are sitting on the sidelines, and we've seen this. Mortgage rates are at their lowest level in about 12 months, and there's been a mini refinance boom for people who have secured mortgages, and now they're refinancing, which is what we've said. Date the rate, lock in the rate, but you can always refinance after the fact.
That's right.
And the Wall Street Journal recently reported that a 0.3 point drop in mortgage rates led to a surge of 80% in refi rates.
Wow. So Matt, this is it. That is the coil. And so what do we do now, Matt? If I know you have some other data points here. Where's the opportunity for an agent? The opportunity is be ready, be relevant. Get your value proposition and your name out there, because when the Coiled-Spring jumps, that's whenever there's going to be a bunch of people jumping on the bandwagon. You need to be driving the bandwagon at that time.
Yeah. I mean, that's a great point, Steve. Just be prepared when the coil is ready to pop.
Yeah, and do the work now. Prepare the fields for rain, Matt, like in whatever. Battling the Giants or something like that.
So a quick mortgage rate snapshot, and because it's the end of the month, we're going to talk some data points. So this is a good talk about mortgage rates. Mortgage rates actually this week ticked up very slightly compared to last week, but you could find a 30-year fix for, on average across the country, 6.2%. Not bad. We're waiting for 6% or lower for the psychological effect and for the coil to pop. 15-year fixed, 5.4% average. Not bad.
Right.
I mean, that really is not bad.
No, not bad, Matt. There were refi booms built around 6.2% back in the day. U.S. existing home sales increase in September, Matt.
So last Thursday, NAR and the local in Illinois and Wisconsin dropped all their existing home data and everything else that goes with that. So we are going to report on it because that's what we do for you guys. So you don't have to dig through all this stuff.
No, just put on the podcast and let your brain expand.
Right. So September, this is for the U.S. September's existing home sales show a steady rebound as mortgage rates eased and housing affordability improved. Number one, existing home sales rose 1.5% month over month to 4.06 million annual rate, which is just over 4% year over year. It's still flat. When you look at existing home sales, around 4 million, if that's what we end this year, it will be the same as it was now 3 years running. Total inventory is at 1.55 million units, which is 4.6 months supply, and that continues to go up. It's 14% higher year over year. And prices, median existing home prices are at $415,000, up 2.1% year over year, and that marks the 27th consecutive month of gains for existing.
So Matt, you have a little bit better demand, a little bit better inventory, and prices going up.
Correct.
Okay, if I'm an investor, I look at that and go, okay, I'm listening. So go ahead, single family versus condo.
So that's a little data point. Single family sales are 1.7 up month over month, and condo sales are unchanged month over month, median price. Yeah, I actually crossed that out.
Oh, sorry, Matt.
No, that's okay.
Yeah, no, that's relevant information, Matt, for some.
Regional trends. So out of the 4 market areas, which include the Northeast, Midwest, South, and West, the only outlier is the Midwest with a negative month over month of just over 2%. Everybody else is above positive month over month. Market dynamics. The median time for the market is 33 days. 30% of buyers were first-time buyers, which actually is not bad.
That's pretty good, Matt.
30% of sales were cash sales, which is a little higher, but it's averaged between 25 and 30 for the year. 15% of sales were investors and or second home buyers, and there was only 2% of sales for distressed properties. So for those out there who think that the sky might be falling soon in the real estate market, unlike 08 and 09, we are in much better positions and people are not being foreclosed on their homes at the rate anywhere close to what
Matt,
it was.
and when the cash sales start to go up versus finance sales, that's also a sign of intelligent, mature buyers that are, purchasing homes, people with a lot of cash saying, this is a place to park my cash hard assets.
And also, just as a side note, we're in the infancy stages of the greatest wealth transfer in our country's history. And I think that a lot of people who are buying with cash, if they don't already have it as a baby boomer or someone even beyond that, they're getting cash from the family.
Matt,
Yes.
on LinkedIn, you either put on your profile open to hire or open to be hired, or I'm hiring, right? So on mine, I have open to receive the wealth transfer. So I'm open.
I can't wait to get a big wealth transfer.
I'm open.
I know a lot of you kids out there, you think you're going to get a transfer of wealth. Don't hold your breath.
Okay, Illinois housing market, Matt.
So Illinois, I'll go talk about the state first and then the Chicago metro market. So statewide sales, I mean, it's up 4.6% from year over year.
September versus September 2024.
So in September 2025, just over 11,000 homes, 11,375 were sold. In September 2024, it was 10,873. So a little more, still relatively flat statewide. Inventory of homes is actually almost 3% lower than last year. So it seems like inventory levels in every other part of the country are going up. Not here. Statewide median sales price is $301,000, which is 3.8% higher than last year. And the steady activity shows buyer and seller confidence despite continued affordability challenges.
Chicago metro, Matt.
Chicago metro market, which is the 9 counties in and around Chicago, home sales are up 5.6% year over year from 7,088 in September of 2024 to 7,484. I mean, that's still relatively flat. Inventory, 6.4% decrease year over year. So there's 14,682 homes for sale. And the median price in the Chicago metro area is $360,000, up 2.9% from September of 2024.
Matt, we had a mastery networking group with wholesalers. So part of it is when people look at inventory, they go, oh, the inventory or whatever it is. You know what? There is inventory out there that has not been identified yet. There are people sitting on their homes that just need a little nudge, a conversation, a postcard, whatever it is. All of a sudden, they become part of the inventory pool. That's what we're finding out.
Yep.
Okay, Matt, forecasts and what are the insights here?
So Illinois home sales are projected to decline about 4% in the last quarter of this year versus last year. Home prices are expected to soften a little bit due to seasonality, but remain about 5% higher year over year by the end of the year. And the declining inventory signals slow recovery toward pre-pandemic levels.
Matt, let's move on to the Dairyland, which is the hottest market in the country right now. Let's talk about it real quick.
So if you missed last week's episode, go back and watch it where we talk about the Wisconsin real estate market and how it is just booming.
Yes.
So September in Wisconsin, statewide existing home sales are up 6.9% year over year. Median sales price of $337,000 is 8.7% higher than last year. And inventory, month of supply is slightly down, but new listings are up 4.1% and total listings are up 3.7% year over year. Year to date, sales are up 2% versus 2024. Median sales price of $326,000 year to date is up 5.2%.
Matt, and we're adding a new element to our, that's excellent data there, Matt. Thanks for putting all that together. Just for Halloween, majority of Americans are not too spooked to buy a haunted house. Let's talk about this, Matt.
Would you buy a haunted house? If you knew your house had some ghosts in it or was haunted, would you still buy it?
Matt, I think every house I moved into or moved out of was haunted after I left, okay? Haunted with just positivity and
I like
just the historical love of family.
So Halloween is this Friday, this week.
Yes.
Halloween, I learned, is the second largest retail holiday after Christmas now.
Wow.
I mean, you look in your neighborhood, I look in my neighborhood. It seems like everybody's got these gigantic decorations.
Yes.
I don't know how many bags. Do you have trick-or-treaters come to your house?
They flood our home.
So let's just say we made the mistake of opening up our giant bag of candy, and I had to buy a second giant bag of candy.
Yeah, you just don't want those kids reaching in, Matt.
So Just a quick, I think this is fun. 65% of Americans say they would at least consider buying the house they thought was haunted. About 1/3 say they've lived in a haunted house, and 18% say they know someone who has. I've lived in a few houses over my lifetime. I don't believe any of them were haunted.
Okay.
And I can't say that if I knew a house was haunted or had ghosts, I would do it.
Yeah.
Too much. Watch the Amityville Horror and you'll see where my opinion comes from.
Okay.
But yeah, so that's the fun part.
Yeah.
Among those who've lived in a haunted house, 43% say the ghosts were friendly. 26% said they were spooky or angry. So anyway, if you want to cover anything
Matt,
else,
I
it's
do. I have
more
a couple comments on it. Number one, I know there's an app out there that you can check into your home and ask the question, did someone die in my home?
Really?
Okay, yes, there is.
Yeah.
We'll report on that next week.
Okay.
The second thing is, there is an old friend of mine who's a mortgage broker, Gene Walters. I believe he's a fan of the podcast, but if not, Gene, we need to see you here. And he actually has Ghostbuster type apparati that he can bring in and identify with the ghost. So Gene Walters, I don't know what mortgage company he works for, but we'll report on that next week.
Not to put you on the spot here, and
Yes.
you don't have to answer it.
Yep.
Do you believe there's ghosts?
Yes, I do, Matt. I believe there are lingering spirits, and I think there's too much paranormal activity, and so I think there are ways to successfully mitigate that. Your energy is probably stronger than theirs, but anyway, so I believe that there are haunted houses.
Yeah, so I would agree with you on that as well,
Okay.
even though I don't believe I've personally.
Yeah.
I may have,
Yeah.
but not.
Maybe we'll dedicate an episode to it, Matt.
We'll get the Ouija
supernatural.
board in here and see what we come
absolutely.
up with. Real
Absolutely.
estate Ouija board.
Ooh,
There's $1 million
yeah,
idea.
there you go. I like
All right.
that.
So other news?
No, Matt, with the other news is we had a great cohort last week with our partners. A lot of great stuff covered, including your economic update. And Matt, I'll put you out there for the general public. If you're looking for an economic update type presentation, reach out to the People Not Titles podcast. Matt has an entire thing he lays out at credibility of your business and really update your constituency on what's happening in the market. Matt, we have a couple of CLEs coming.
Yeah, we've talked about it, but I'll highlight that next week we have our first November CLE, so that's the 6th of November, which is a Thursday. It'll be in the Loop. If you have not yet registered, it's going to be great on deeds, tenancies, and homestead, and another section on the Northwest Side, Housing Preservation Ordinance. Our presenters are the best. We're the leader in attorney education. Get on board and register today.
Matt, I was just going to go to the end, but we can't. We have to address the Bears' 4-game winning streak has ended in a pathetic fashion with a lackluster and limp-wristed effort against Baltimore.
So I am pleased to say that I listened to the first half and then some because I was on my way back from Ohio.
Yeah.
And when I came home, I said, I'm glad I didn't see what I just heard because I would have been even more upset. So I'm not sure if you saw what I heard.
I did watch some of it, Matt,
Okay.
and it looked as pathetic as it sounded.
So yes, unfortunate, a regression, a Lamar Jackson, no Lamar Jackson
I thought it was
in
going to be a
Baltimore.
shoo-in. Lamar's not playing. We're going to win, Matt.
I think everybody felt the same
Yeah.
way, and it was a regression and an unfortunate loss. So
Matt-
hopefully they can regroup. The World Series has been tremendous. I don't know if
Yes.
you've watched that.
I stayed
mean,
up late, Matt.
I did not stay up for the 18
I
inning.
stayed up for the 18 inning, 2 baseball games in a row. I know it
What time did it end?
I think it ended at 2 in the morning. Yeah.
Jeez, good for you.
At the 18th inning, some real heroics, real excitement. I was kind of doing work and watching and having conversations and such. But Matt, we are not giving up on the Bears. I just want to go back to that because I believe this is the evolution of a great team, and we're just going to see them continue to rise. This happens to these kind of first-year coaches with that kind of younger quarterback. So we'll see. We're ever optimistic, and we're not down on Chicago, Matt.
Never down
We are
on Chicago.
up on
We love.
Chicago. Okay, so this is the People Not Titles podcast. Signing off, Matt Lombardi,
Next week.
Steve Kaempf. See you next week.
All right.
Hey, thanks for listening to the People Not Titles podcast. We are proudly sponsored by Land Trust Title Services. If you enjoyed the podcast, please hit the like button, Please subscribe, and we'd love it if you'd share our podcast with your friends. Thanks a lot.